Good afternoon, everyone. This is Saveda Inside ETF. We'll get started with our ETF 401 webinar series in just a moment as we allow those in queue the opportunity to go ahead and get dialed in. We will begin in just about a minute. We thank you for your patience. Hello, everyone, and welcome to our Inside ETF University webinar series. Today is part 4 of our 5-part webinar, ETF 401, Fixed Income Factor ETFs, an Investor's Best Friend. I'm Saveda Nirona, Director of Conference Content here at Inside ETFs, and your host for today's webinar. Before I turn this webinar over to Pierre, our moderator for today's webinar, I'd like to take a few minutes to thank you, the listeners, for joining us today and to go over a few basic housekeeping items to enhance your webinar experience. We will be applying for CE credits today, so you will get an email notification with the certificate within the 6 weeks. At the bottom of your console, there are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit a question. Our speakers are happy to answer questions throughout the presentation, so don't be shy to ask it when you think it. Our speakers will do their best to get through all the questions. However, if a fuller answer is needed, or if we run out of time, our speakers will do their best to follow up to get those questions answered. We capture all the questions, so go ahead and submit them early. We will get to them as soon as we can. You can expand your slide area by clicking on the Maximize icon located at the top right of your slide area, or by dragging the bottom right corner of your slide area. If you have any technical difficulties, please click on the Help widget. It has a question mark icon and covers most common technical issues. An on-demand version of the webcast will be available approximately 24 hours after the conclusion of today's webinar, and that can be accessed using the same audience link you used to log into today's webinar. Our moderator for today is Pierre Daly, co-founder of AdvisorAnalyst.com, a leading online magazine for Canadian investment professionals. Pierre Daly always had an interest in investments. He spent 15 years working as a broker with a leading firm in Toronto. After selling his book of business because he was burnt out and didn't know where else to go, blogged for a bit, and he was asked to join a growing Canadian mutual fund company. Spent 5 years in an executive advisor-facing role, growing AUM, and realized he enjoyed being a source of useful insights to advisors rather than clients, with his keen interest in staying ahead of the markets. Visit and read How Insight is Capital at AdvisorAnalyst.com. Pierre, the floor is all yours.
Thanks, Saveda. Really happy to be moderating this webinar, ETFs 401, Fixed Income Factor ETFs, an Investor's Best Friend. Our speakers today are Alfred Lee and Kevin Prinz. Alfred Lee is a Director and Portfolio Manager for Exchange Traded Funds at BMO Asset Management, Inc. He's Portfolio Manager where he manages fixed income and preferred share-related mandates for both institutional and related retail clients. And as part of the global fixed income management team, he's involved in the management and trading of a wide variety of portfolios, including Canadian bonds, U.S. investment grade, high yield, European and Asian bonds, emerging market debt, and others. Previously, he worked for a large Canadian-based brokerage developing ETF-related strategies and sat on the firm's investment committee. Alfred is a graduate of the University of Western Ontario, majoring in economics, and holds the CFA, Chartered Market Technician, and Derivatives Market Specialist and BMS designations. Kevin Prinz is Managing Director and Head of ETFs and Managed Accounts at BMO Global Asset Management, Inc. With more than 18 years of industry experience in banking, securities, mutual funds, and financial education, Kevin provides a rare combination of both industry knowledge and educational expertise on exchange-traded funds. During his career, he has authored several investment industry courses for the Canadian Securities Institute, including the recent development of an ETF-focused course. Kevin frequently interacts with portfolio managers and investors about the benefits of ETFs and how they can be used to add value to any investment portfolio. He's a regular contributor to investment industry publications, has also been a guest speaker and panelist at industry events, and has appeared several times on BNN. Kevin has an MBA from Dalhousie University and holds a number of industry designations, including FCSI, CIM, and CFP. So now
Thanks,
I'd
Pierre.
like to, Alfred, why don't you take it away with the fixed income playbook?
Yeah, thanks, Pierre. And actually, what I would like to do is even have you join us and interact on this because of your expertise, of course, too. Really, our thought process today is to really talk about fixed income ETFs, give people background on fixed income ETFs, talk about the markets for that matter, and then maybe share some thought processes around constructing fixed income ETF portfolios, and maybe looking at a guided ETF portfolio for that matter across the board. So with that, let's get at it. First thing I'm going to ask, and maybe Alfred again, Pierre, the first thing is fixed income has kind of been that fastest growing segment of the ETF market. We've certainly seen some growth here in Canada. What are some of the key reasons behind that growth? Maybe, Alfred, you can start with some thoughts.
Sure. So I think there's a number of different reasons. You're absolutely right, though. We've seen a phenomenal growth in the ETF industry over the last 10 years. And in the last 2 to 3 years, exceptionally, especially, we've seen a lot of growth coming from the fixed income ETF part of the market. And I would say for a number of different reasons. If you look at ETFs and the characteristics and why they resonate well with many different types of investors, I would say there's 3 major reasons. They're cost efficient. They allow investors to access many different parts of the market. They're also transparent as well. When you look at the underlying bond market is very different, where I would say in terms of these 3 major characteristics, it's almost a complete opposite, where you have an over-the-counter market, so you don't have a lot of transparency. Also, very wide bid-offer spreads in certain parts of the fixed income market. Also, if you are an everyday investor or even an advisor, if you wanted to access, say, a certain part of the market, say the high-yield bond market, emerging market bond market, it would just be very difficult. With an ETF essentially addresses all these shortcomings of the fixed income market. And I would say those are the major reasons in why we're seeing the fixed income market really grow. So if you look at the data on this slide over here, what you'll notice is that if you look at the 2017 fund flows, where we've been seeing a lot of fund flows is absolutely fixed income ETFs. And if you look at the year-over-year AUM growth, we've definitely been seeing a steady growth in fixed income ETF AUM as well. And, a common question we get on our desk is, have we reached almost a boiling point in terms of fixed income ETF growth? And I would say no. Every day, I would say we're having, new conversations with both retail investors and also institutional investors in terms of how we could help build their book of business as well. So because of that, we definitely think that we're just scratching the surface in terms of ETF growth in terms of the fixed income market right now. So I did mention about bid-offer spreads. Bid-offer spreads, I think, is a good illustration on why fixed income ETFs are really, a cost-efficient vehicle for investors to access the fixed income market. So very often we lead off with a slide in terms of our presentations and in terms of meetings that we do. Retail advisors that are accustomed to trading ETFs are well aware that ETF bid-offer spreads are a lot more cost-efficient in terms of offering tighter bid-offer spreads than the retail trading desk. When we meet with a lot of our institutional investors, they come away often surprised that the bid-offer spreads on ETFs are actually tighter than the institutional spreads themselves. And I would say the major reason why is because when we launch an ETF, the bid-offer spread is essentially the institutional spread. But as an ETF matures and you get that secondary market trading, an ETF becomes more efficient and the bid-offer spread on that ETF is tighter than the underlying market just because of that secondary market liquidity. So a good example is that when you buy an ETF or a mature ETF, the likelihood is that you're buying that ETF off of an ETF seller. So a good stat that we often bring up is that if you look at high-yield bonds as an example, a high-yield bond ETF, for every dollar that's traded, on average, about 13 cents needs to access the underlying market, meaning that 87% of the day-to-day volume is offset by secondary market liquidity.
And that's a good point because, people look at the cost of ETFs, but here's a great example of actually the savings because you're getting even better than institutional savings, even better than retail and better than institutional. So that's just a very good point.
So there was a question I just wanted to ask on behalf of the participant. The question was that a correct number on the previous chart with fixed income AUM 45,000 millions? In other words, 45,000 on the previous chart on this slide that's live right now. The question was 45,000 million.
That'd be 45 billion in terms of fixed income AUM, approximately.
Right. Anyway. All right. Let's go on.
And credit to National Bank for providing that stat too. Let's give them credit.
One other thing I'd like to bring up is if we flip to the next chart. When you look at fixed income ETFs, what we're really noticing now is that whereas before, I think when fixed income ETFs started gaining prominence in the last 5 years, I would say fixed income ETFs were really viewed as competition versus active management. And what we're seeing now is that fixed income ETFs are actually seeing we're seeing them displace individual bonds as a means to access the underlying bond market. So what you'll notice is that we talked about the secondary market liquidity, which makes them more efficient as access tools. But if you look at the structure of a fixed income ETF, it's very different from an equity-based ETF. An equity-based ETF, when you look at the S&P 500, for example, the market maker or the portfolio manager has to go out and buy the 500 stocks of that index. For fixed income ETF, given that the underlying market is, an inventory-based market, you can't go out there and buy the 1,600 securities in the FTSE TMX universe. We use a sampling process. So we're essentially going out and buying the most liquid bonds that we could execute on a fair price. So because of that, it allows the fixed income ETF to be more efficient in terms of executing larger trades. So, for example, if we were to get a buy or sell order of 300 million, because the ETF is so diverse, we're essentially taking that 300 million and sprinkling that across, hundreds and thousands of securities. So, if we were to do that with, a basket of bonds, so say, 300 million worth of, 4 or 5 different bonds, the probability that we would push up the market or to leave a footprint in the underlying market would be far more probable when we're executing in a small basket of 4 or 5 bonds rather than going through that ETF. So the ETF essentially allows us to leave less of a footprint.
Yeah, I think it's a good point. You've certainly seen it from advisors across the board that inventory of respective desks used to be very high for bonds, and I've certainly seen that diminishing across the board as firms have other uses for their capital. And I've certainly seen the ETF step up in that space as that liquid alternative to get access to that bond and put that portfolio on a regular basis. One thing Alfred, is we just getting into a little more deeper because you were talking about fixed income ETFs. And for the most part, people looking at fixed income ETFs as maybe passive investing, and we're certainly hearing a conversation on fixed income passive. And what's your thoughts on passive and active in this space in a rising rate environment?
So I'd say, the common narrative, especially in the last 2 years, is that you don't want to be in a passive structure given that it's a rising interest rate environment. And, that's the common narrative that we've been hearing. But if you look at the data, I would say if you go look at the Morningstar data, for example, and you look at, say, a broad-based fixed income ETF, a lot of people say because, the broad-based fixed income market has a duration of about a 7.5 right now. In a rising interest rate environment, because you're longer duration, you're going to get negatively impacted by rising rates. The fact of the matter is that if you look at the data, the Morningstar data, which includes both passive and active mandates, what you'll notice is that something like ZEG, which is our broad-based fixed income ETF, 2016, rising interest rate environment, it was essentially 50th percentile, meaning that it beat out 50% of its competition. 2017, again, a rising interest rate environment, 31st percentile, meaning that it beat out 69% of its competition. So, the point I'm trying to make is that, even though we've been in a rising interest rate environment, something like a broad-based fixed income ETF still makes a good solution for the core, the foundation of your fixed income portfolio.
That's a good stats. I think a lot of people are not knowing those stats because they maybe not looking at those details that you can see the passive participation in the marketplace. Maybe you can give me some more insights on that, and maybe duration be an example of something you can give some insights around.
Yeah, so I think when you look at duration, I think very often people think calling duration is a very easy thing, and I think hindsight's always 20/20. So to better illustrate that, what I did was went to my Bloomberg terminal and I essentially took us back to the beginning of 2016. In the beginning of 2016, what you'll notice here is that if you look at interest rate futures and what the market was implying, a good part of the market, so 35% of the market, was actually calling for an interest rate cut. Only a small portion of the market was calling for an interest rate hike. So about 17.7% was calling for a rate hike by the end of the year. So, what this tells you is that, as a reminder, the very first Bank of Canada meeting, which was January of that year, the Bank of Canada came out and says, we're done with cutting interest rates. So what that shows you is that, very often in practice, very often calling duration or even calling credit consistently and calling it correctly is very difficult to do. So the fact of the matter is that, again, hindsight is 20/20. In practice at that point in time, it's very difficult to do so.
Maybe you can talk about, there's some recent reports out by SPIV and that kind of stuff, and I know we got a slide around that. Maybe you can give us some insights on that.
Sure. For, SPIVA now...
What does it stand for? Sorry, we should at least clarify.
S&P is active. Sure.
Sorry, just Alfred, there was just a quick question about the chart, the previous chart, not I think from 2 slides prior. We can just go back. This was...
The Morningstar chart or the Bloomberg chart?
One of the charts was 5 years old. Oh, yeah, it was the assets up, inventory down chart on slide 20. And the question was, what does the chart look like now?
So that's a good question. So this was, I couldn't find any current data, but this is a similar story to what we're seeing today, which is ETF growth. We're seeing assets in ETF go up, and the common story has been dealer inventory, just because of things like Dodd-Frank, new regulation being brought in. Dealers are less able to hold inventory as part of their desk right now. So very often we see news and publications come out saying that this potentially is a problem for not only ETFs but also mutual funds as well, because the market is going to be less liquid. The stats I would say right now is very similar, but I think what a lot of news outlets are missing, or the dialogue that people are missing, is actually how fixed income is traded nowadays is very different than even 5 years ago. So a lot of the market has gone to electronic trading, which allows portfolio managers like myself to access inventory and find inventory at executable prices is far more efficient now. Electronic trading is also allowed for open trading, which allows not only portfolio managers like myself to deal with the traditional dealing desks, but also allows me to deal with different buy-side participants as well. So, for example, if I'm out there buying a bond and PIMCO or Fidelity is out there selling that bond that I'm looking for, the electronic trading platform essentially allows me to deal directly with them. And last but not least, I would say, the major change we've seen in the fixed income market is trading has also, gone away from, traditional dealers. So we've also seen, especially in the U.S., a lot of specialty dealers kind of pop up and a lot of regional dealers pop up where they focus on, certain parts of the fixed income market, and also introduces, a different liquidity pool dealing with, hedge funds and also things like distressed debt dealers as well. So it allows for greater liquidity overall in the market.
Okay, great.
Thanks for that, Pierre.
Thank you.
So I think we were talking about the SPIVA report before then. So SPIVA stands for the S&P Index versus Active report. So what I want to highlight here is that, this is essentially a comparison or a report that compares active management versus the relevant indexes. So what this chart shows you right here is essentially the percent of active managers underperforming their benchmarks. So what you'll notice here is that, on average, active management tends to lose out to its respective benchmarks. However, where we've been seeing active management add value is certain areas such as investment-grade short funds and investment-grade intermediate funds as well. And I think, from our point of view and from my point of view, I think, the best portfolios actually include both elements of active and passive in one portfolio. And how you properly allocate active risk, I would say, is look at those areas which active management has had a tendency or historically had a higher probability in beating the index. So investment-grade short funds and investment-grade intermediate funds being a good example of this. So allocate active risk in that way, and allocating to an active manager in those areas where they have a higher probability in beating the index.
Hey, Pierre, maybe we get your thoughts on that too, on active and passive.
Well, there's a really there's a really strong argument to be made about the bond market in particular with regards to active versus passive, and there's a very strong argument, of course, in favor of active because of the way bond markets trade, and then there's also a question about the evaluation that's required on different bonds, like especially when you get into the high yield space or the corporate space, corporate credit. It really pays to have a sort of evaluation model based on fundamentals, as opposed to buying an entire grouping of high yield. But I guess it varies. There's active, and then there's factor, smart beta for these. Maybe you can touch on the controversy over active versus passive, particularly with the corporate credit, with the credit market and high yield space.
We're certainly seeing in the corporate space, even Morningstar brings this up, that of any outperformance of active managers, it's really attributed to right now a credit call than anything else, right? It's not really attributed to much more of that. This is for North American, right? Like, it's one thing when we look at active management out there, I kind of separate between global, where you may want to look at different countries' bonds and the currencies. That gets a little more complicated. But on a domestic basis, you've got a more of a simpler viewpoint when you look at the Fed or the inflation of the marketplace. So I think when you look at active and passive, you kind of have that global versus domestic viewpoint too, and that's also part of the overall consideration process out there. And we even got a thought process to work through a little later on that, and certainly walk through. But what we are seeing, of course, in the marketplace, and this is a great stat in the States, is that 57% of advisors are mixing active and passive together. And that makes a lot of sense, because in some cases you want to save some money. You're certainly seeing from the SPIVA data set here that there are times when passive outperforms, there's times when active outperforms. And having a combination of the two allows you to, A, save some money, and B, get some performance in the marketplace too. So that it might be a best of both worlds kind of approach.
Yeah, so there's a comment from the audience, from an advisor. The comment is more of a comment than a question, but maybe you can address it. The only thing I see on the active versus passive management indices slide is that there is a high degree of variability from year to year.
And then that's exactly what I was saying. Really, it is a best of both worlds approach, right? I think you want to look at that, right? In some cases, we have good conviction in the marketplace or thought in the marketplace. Certainly a passive approach because you have the tools now in your hands. And there are other places where maybe you don't have conviction, maybe you want to hand that off. And the other aspect, of course, blending the two together is probably the optimal approach, is having that, because sometimes passive will perform and sometimes active will perform. Having the two together is the way of basically benefiting from both at the same time.
And I think another thing that is that if those areas where you do have greater dispersions, where you have more wild swings or whatnot, those are potentially good areas in which you want to allocate active as well, because with an active manager, you are able to potentially reduce that volatility. So again, I think from my point of view, I think the most efficient portfolios definitely include both elements of active and passive.
So let's cascade here for a second, because one of the bigger challenges we get out there in understanding of fixed income in general is the conversation around duration itself. And one thing we've been big advocates of making sure people see the duration of ETFs out there. But maybe, Alfred, you can give us a little comment around that, because if you look at duration, for example, of the broad market in Canada, or represented by a ZAG ETF, you're seeing a duration around 7.5. Mm-hmm. But interesting, because normally you would think that with a duration of 7.5%, when Bank of Canada starts raising rates as they have done, that would normally naturally mean, or people's textbook would say, that would be a challenge for a longer duration. Yet we saw positive returns in broad markets last year. Maybe you can give some explain of why that is happening.
Yeah, so I think this was a common question that we got on our desk, especially in January, as we saw a lot of the calendar year returns in 2017 kind of trickle in. I think it left a lot of people a little bit puzzled, given that in a rising interest rate environment, a lot of people were surprised that we saw positive returns in the fixed income market overall. And the reason being is that when you look at duration, I think duration only applies when you're looking at two relative or bond-related products. When you get a parallel shift in the yield curve, and very often you don't get a parallel shift in the yield curve. So last year was a good example of that, where we essentially got a flattening of the yield curve. So if you look at the shift in the yield curve year over year, what you noticed was that short-term rates went up due to the expectation that the Bank of Canada was going to tighten monetary policy. But on the long end of the curve, we essentially saw rates decline by a little bit. So that benefited long bonds. Where we saw a little bit of underperformance was actually on the short end of the curve, which is a little bit counterintuitive given that it was a rising interest rate environment. But we also saw a tightening in credit as well. So corporate bonds performed well. Provincial bonds also performed well due to that tightening credit. So that's where we saw a lot of the attribution, due to tightening credit and also the performance on the long end of the curve.
Yeah, I don't think we would actually, because normally you'd see a parallel shift in the yield curve, but certainly didn't see that last year. We often show duration, I think it's one of those key challenges out there, as a number. Maybe you want to dive into that more and what it means towards building a portfolio.
Before we do that, can I just go back to, can I just take you back to the SPIVA slide? Sure. There was a question, that we might not have to actually go back, but the question was, were the active managers' results net of fees? Do you know?
I believe they are net of fees for the SPIVA report.
Okay, perfect. Thank you. I just have a comment about duration, and because I've heard some very strong arguments made recently that interest rate risk is, on a relative basis, interest rate risk right now is relatively much higher than credit risk, and so given the choice between taking interest rate risk or duration risk, the argument was in favor of credit risk, which right now in a rising rate environment is certainly lower, and that would indicate favoring floating rate type investments or floating rate portfolios. I think if you can comment on that.
Sure. So I think in the short, if you look at everything from a short-term perspective, I think if you look at interest rate expectations, I think they're still a little bit hawkish right now. I think last year when the Bank of Canada was raising rates, we got 2 rate hikes, but we saw a lot of economists on the street expect something like 4 rate hikes in 2018. So I think the market and bond yields especially, I think, are normalizing right now. So over the short term, we could see potentially bond yields on the short end of the curve move down a little bit. But outside of, say, 3 or 4 months, I think once the Bank of Canada starts hiking rates again in, say, July, I think, the market's going to be, again, focused on, raising rates or having concerns about rising rates again. So I think over the short term, I think, floating rate may be a little bit sensitive given that we get a little bit of repricing on the short end of the curve. But over the long term, I think we still remain in a rising interest rate environment. So things like, floating rate bonds and things like rate reset preferred shares are still a good hedge in your overall portfolio in terms of hedging rising interest rates.
So recently with the other thing is recently with the volatility in equity markets that we've seen, there hasn't been the corresponding drop in longer term yields. So it seems investors aren't necessarily seeking flight to safety in some of the in longer term treasuries or longer term Canadas.
No, I think, overall, if you look at longer-term yields, I think, that's driven more by, economic growth expectations and also inflation as well. So right. Overall, the market's expectations for that hasn't really changed. I think, what's really been driving the market right now is just kind of a normalization in interest rates. So, both north of the border and south of the border, I think, last year, I think expectations just got a little bit ahead of themselves where, people were expecting multiple rate hikes this year. And then, we just get into repricing in terms of bond yields right now on the short end of the curve. So long-term yields are, unchanged largely.
Interesting, Pierre. I looked it up recently, and the last time the Fed started raising rates, we all know 2004, 2005, wasn't a parallel shift back then either. It was kind of more of a flattening of the yield curve. And I even look back further in 1999 and 2000, that's when the actual curve started to invert that time when the Fed started raising rates. So, you look at shifting of the yield curve and implying what duration means as a number, it's a little more challenging, maybe looking at the short and the long term. And so you're certainly seeing right now, though, the longer end of the yield curve behaving very different than the short end of the yield curve across the board.
Yeah, I think you kind of addressed the duration. You kind of addressed it early in the presentation that duration calls are not that easy to make. Right? Isn't that?
Well, it's almost it's almost like two decisions. Maybe Alfred, you talk about that. It's not just right. One. It's kind of almost odds.
Mm-hmm. And I think there's a primary effect where you got to call duration, and then usually there's a secondary effect which is credit as well. So usually in a rising interest rate environment, you have a tightening of credit, which tends to be the secondary effect most of the cases, unless we're raising rates due to inflation. So right now, we're definitely getting a rising interest rate environment because of a stronger economy. Economic data still remains robust, which should be supportive of tighter credits in the over the next 10 to 12 months.
Right.
So maybe, Alfred, interest rates have gone kind of one way the last 30 years, right? That's pretty fair to say. Essentially grinding lower. I mean, let's talk about the bond market. Is the bond bull over, right? Talk about that.
I think that's been a common concern, given that interest rates are going up. We're definitely in a rising interest rate environment right now. Whether you look at North America, the Bank of Canada has been raising rates, the Fed has been raising rates. Outside of North America, if you look at the Bank of Japan and the ECB, they're talking about removing QE as well. So that overall has that same net effect on interest rates. So we're definitely in a rising interest rate environment right now. So longer term trend in the last 30 years, we've had a declining interest rate environment, a long-term secular kind of bull run in terms of bonds. So the common concern is that because interest rates have kind of been breaking out of this pattern, bonds are going to fall off a cliff as we saw in the 70s and 80s. And I would say, overall, if you look at the underlying fundamentals of the bond market and also demographics of the overall population right now, it's very different from the 70s and 80s. First of all, if you look at 70s and 80s, the baby boomers essentially were entering their peak productivity years, earning more, also spending more. So in terms of stimulating the economy through the money multiplier, velocity of money and whatnot, it had a more stimulative effect on the economy. So now those baby boomers are actually entering retirement where they're actually saving. So that velocity of money has really slowed down. Also, kind of relating to that, in terms of their portfolios, instead of buying equities now, a lot of them are de-risking their portfolios and actually buying bonds. So as interest rates are going up, you have this overall demand for bonds, which potentially places somewhat of a cap on interest rates and how far they could go up. And when you look at inflation right now is not much of a concern compared to the late 70s and 80s. Look at Canadian CPI, came in at, I think, 2.1%, which was the last reading. A little bit ahead of expectations, but still well within the range of the Bank of Canada's target rate of 1 to 3%. So in the U.S., we're a little bit more concerned about inflation there, but still, not the double-digit concerns that we saw in the late 70s and 80s when Paul Volcker had to come in and raise interest rates to double digits.
So, okay, there's challenges out there, and why do you believe fixed income is still kind of a more important asset class for investors?
Overall, I think a lot of people get away from, fixed income is still a great stabilizer for a portfolio. So in the last 10 years, we've obviously been in this reflationary environment where, central banks have been kind of reflating assets. So because of that, bonds, equities, and commodities, all asset prices have been, highly correlated. But in those brief moments, the last month being a good example, when the equity market has sold off, bonds have performed well. So it's a great stabilizer for a portfolio. When you look at the three major crises, so the Black Monday, dot-com bubble, and also the 2008 crisis, as the equity market fell, sometimes in excess of 30%, bond market actually performed well. So, when we have a lot of, conversations and dialogues with a lot of investors out there, very often we hear investors are, shifting away from bonds and actually buying things like dividend-paying equities. And they say to themselves, you know what, bonds are actually paying me next to nothing right now. Coupons are going low. So I'm going to use dividends instead of bonds. And I think the fact, what they're forgetting is that at the end of the day, dividend-paying equities are equities. So when the market sells off, they have a very high correlation with, your traditional equities. So they don't provide that balance to your portfolio.
The fixed income tends to offer investors out there.
I agree with the argument that given past experience with market sell-offs, that the yields on 10 years have provided protection to portfolios where you have falling, you have markets shifting out of equities and into bonds. Outside of that, with interest rates on you made the argument that that because of the changing demographics, there's probably a cap on interest rates on the long-term bonds, and that bonds are a great defensive measure. But what about the argument where an investor gets into a portfolio with a slightly longer duration and let's say a yield of 2.5% to 3%, for their holding period? First of all, it's not a terrific yield. There's obviously an argument to be made that if the market goes on a risk-off sort of basis for any lengthy period of time, that investors would fly to safety into the bond market and into let's say 10 years, or even slightly less duration. The argument is what's the likelihood that an investor, given facing duration losses in their bond portfolio, won't get out? In this case, we're talking about behavior. Obviously, if they sat there for the entire term and through all conditions, that bond allocation could provide a balance in terms of the volatility within their own portfolio. But how do you I think for the advisor, how do you get your client to stay in a bond or a bond fund that has duration risk or interest rate risk in a rising interest rate market? And this is probably that's at the heart of investors moving away from bonds and into dividend-paying equities or equivalents like high yield or corporate credit, floating rate type instruments. How do you get an investor to stay in paper that's yielding 2.5%, 3% for a long period of time without getting bothered by the interest rate volatility, or the volatility in yields?
I would say there's two parts of that. I would say when you are allocating to, say, a long duration product, never allocate 100% of your portfolio to a long duration product. I think
right.
The best way to kind of bump up or increase the duration in a fixed income portfolio is essentially have your core exposure, whether that be an ETF or an active manager. And at those times when you want to tactically increase your duration, what you do is you buy a longer duration ETF in order to slightly bump up that duration. Never allocate 100% to a long duration product, because to your point, I would say if you're short duration and you're wrong on your call, the likelihood of that doing damage to your portfolio is highly unlikely. If you're long duration and you're wrong on that call and you have a duration of say 13 or whatnot, that's going to have that's going to do a little bit more damage, or potentially a lot of damage to your portfolio. So never allocate 100% to a long duration product. And overall, I would say the best way of looking at duration or long duration products is never in isolation. It's always the net effect to your overall portfolio. So it's kind of more of insurance against a black swan event. So even though
it's very tactical.
Yeah. So if you look at long treasuries, which is entirely a long duration play, so it's an interest rate play. There's no credit involved. In isolation, if you look at it, I mean, it's highly volatile. It's almost like equity market risk or equity market volatility. But when you look at it in isolation or in combination with the other side of your portfolio, so the equity side of your portfolio, because it's at times negatively correlated to the equity side of your portfolio, that volatility in bonds is going to offset some of that volatility in the stock side of your portfolio. So never kind of look at everything in isolation when you're looking at a long duration product. It's always in combination, how it works with other parts in your portfolio.
Maybe talk about that, Trish. We've certainly seen a run-up in interest lately. Why is that? You've certainly seen a pickup.
In the last couple of months?
Yeah.
We've seen a lot of headline risk, with Trump talking about, trade wars, tariffs, and whatnot. Also, we've seen equity markets kind of just, a lot of concerns about the equity market being overvalued right now. So I think we're getting a little bit of de-risking right here. Investors are a little bit concerned that, we've definitely been a longer run in terms of both the equity market and also the credit cycle as well. So I think we just get some profit taking here. So a lot of people are just kind of de-risking their portfolios, moving out of equities and moving into bonds to kind of hedge out that tail risk.
I got a question. There's a question. Can I just interrupt you guys with a question? It's so the question is, what about preferred shares? Will they provide income and lower correlation to equities?
Yeah, they are. I mean, I think one of the big benefits of preferred shares, both Canadian and U.S. preferred shares, is that they have a very low correlation, or they have no correlation to both equities and bonds. So one, they provide income, and the other great benefit of preferred shares is that they have a very low correlation to traditional assets.
That's kind of a nice benefit. A lot of people overlook it's almost like a third asset class in itself. It has low correlations, Alfred said, to fixed income and to equity. So it is a diversifier across the board.
Yeah, so for Canadian preferred shares, I mean, a lot of the market is rate reset. So when you look at the other assets in your portfolio, whether it be equities or bonds, in a rising interest rate environment, a lot of these assets tend to be negatively impacted by rising interest rates. So things like rate resets are one of those few asset classes that potentially help you to hedge out, that rising interest rate risk. So floating rate bonds being another good example of, a portfolio hedge against rising interest rates.
And you're a fan of preferred shares. In fact, actually, what I'm going to do is I'm going to jump to something Alfred put together for this presentation today, or this session. He put together a sample model portfolio. It's called a guided portfolio. And maybe you can walk people through not only your thought around the preferred shares inside there, but also maybe your whole decision tree process and maybe putting together that portfolio. How do you arrive at that? Maybe give people a thought process about how they can tweak it from there for their own personal use.
Sure. So this is a sample portfolio we put together. Essentially uses a core and explore kind of strategy where a broad-based fixed income ETF such as ZEG is the core of a portfolio. So essentially, as you have higher convictions on the market, you reduce your exposure to that broad-based fixed income ETF. When you have less convictions about the market, so say in a declining interest rate environment, you increase your exposure to something like ZEG. So right now, because there's probably higher convictions about overweighting certain parts of the Canadian fixed income market, also allocating to areas outside the Canadian fixed income market, that exposure to ZEG is only 50%. So something like corporate bonds right now, I'd say from a technical level, when we are trading corporate bonds, what we're noticing is that demand far outstrips supply right now. So when you see new issues come out, average fill rates are very low, which tells you that there's still a lot of demand for corporate credit on the sidelines. So for the time being, over the next 6 months or 8 months, we still believe or still feel very positive about corporate bonds, investment grade corporate bonds.
So the degree you feel comfortable in the economy, or so you're a little bit weighting a little more to corporate bonds or federal governments or provincial bonds for that matter.
Yeah, and I'd say to my point before, I'd say in a rising interest rate environment, outside of 4 months, we still believe we're in a rising interest rate environment because rates are rising right now because the economy is improving. The secondary effect of that is credit spreads still remain tight or will tighten. So that tightening credit spread will offset some of your duration risk. So investment grade, U.S. investment grade is also another good example where we feel very positive about investment grade bonds in the U.S. as well. It's a great diversifier. So one common drawback of corporate bonds in Canada is that, similar to the equity market, the industries are very highly concentrated in a few number of different industries. So investment-grade corporate bonds in the U.S. is a great diversifier, offering us exposure to a lot of different industries that we just simply don't have up here in Canada. Also exposure to a lot of blue-chip names as well. Provincial bonds, short-term provincial bonds, the reason why we have an allocation here is because, as I kind of mentioned before, even though we are in a rising interest rate environment, I think expectations in terms of the Bank of Canada's the pace in which they're going to increase rates was a little bit too hawkish in the last 6 months. So because of that, over the next 3 to 4 months, we're probably going to get some normalization in the short end of the curve. So that's why we have a small tactical position there. So we also mentioned a little bit about treasuries. Treasuries, we have exposure ZTM, which is our midterm U.S. Treasury ETF. The reason why we're allocating to the mid part of the curve and avoiding the long end of the curve is because in the U.S. we're still a little bit concerned about inflation picking up by the end of the year. So for that reason, we want to avoid the long end of the curve. And going to my next point, preferred shares, we think it's a great diversifier. Canadian rate resets or our ETF ZPR offers exposure to rate resets. So outside of 3 to 4 months, we still believe we're in a rising interest rate environment. So again, this is a good hedge against rising interest rates. In U.S. preferred shares, it's another great diversifier, low correlation to traditional assets. The way I view this is that it's an alternative to playing investment grade and high yield. Similar to investment grade, it's mostly investment grade issuers, but similar to high yield, it offers high yield, and also where it's different is that the credit quality of U.S. preferred shares is 2/3 investment grade, so a much higher quality issuing universe compared to high yield, even though you're lower down in the capital structure.
Then you're looking at this aspect, and one thing you have inside here is a U.S. ETF, but I notice it's also, of course, hedged. So it reads in the conversation about currency. What's your thoughts on currency right now?
So when you're looking at currency in the fixed income portfolio, I think there's two common ways of approaching it. The first camp says when you're dealing with fixed income, you don't want volatility. Currency, because it is volatile, you want to eliminate that currency risk, so you should be hedging it at all times. So that definitely makes sense. There's another school of thought that says, currency is a great additional source of return, so I want to play that tactically. So that's another way to approach it as well. So a couple of months ago, we were a little bit more bullish on the U.S. dollar, given that we thought interest rate expectations in Canada was a little bit too hawkish. So we thought the U.S. dollar was undervalued at the time. Coming into the year, we told people to hedge their U.S. dollar, given that it had run up and it's bumping up against that resistance level. What we're seeing now is that we're seeing a lot of investors kind of go short in terms of the Canadian dollar. So because of that, we do expect the Canadian dollar to potentially bounce back in the next couple of months, which is a good reason why we want to continue hedging that U.S. dollar exposure right now.
And just one little note for anybody out there, if you want to have this kind of thought process of this guided portfolio sent to you on a regular basis, you can access it on the BMO's ETF dashboard. That's our bmoetfs.ca dashboard. Alfred's going to put it up once a quarter, but it's really more of a thought-provoking approach, saying here's a place to start, and then think through your thoughts around inflation. Think through your thoughts, of course, your active passive conversation first, and then really looking at your conviction market, being from the broad market to individual ETFs, and the individual ETFs looking at that conviction you have in the market itself, corporates or federals, and then of course diving into the duration call, which is your short term, is the federal government, Fed moving or the Bank of Canada moving, versus inflation for your long term calls, and bring it all together. I guess last but not least, currency and then treasuries is kind of your additional thought process of saying maybe there's a market that you want to really protect against that move. Let me just, any further thoughts on that? Or maybe we'll pass it back to Pierre, too, for closing thoughts on that.
I don't have anything to add. That was pretty enlightening, guys.
Perfect. Well, maybe we'll open it for a couple more questions. I see we got about 9 minutes left or so. If there's any more questions, we can certainly bounce it around.
Yeah, it's I think it's one of those transitional periods right now where we've come off a very strong equity market and historically very strong fixed income market, and now it's kind of a difficult period in terms of looking for value and opportunity in the market, and fixed income is one of those areas it's vast. And in some ways, it's certain respects, it's mysterious as well. But that was very enlightening. I think it was very thoughtful presentation, very enlightening. And I don't know if I just want to go back to the next to last slide. I think slide 22. I think one of the things that I sort of noticed last week and heard about was the fact that even in the face of the the volatility in equities last week and over the last period since February that we've seen with markets down back to their with equity markets down back to their February or near their February lows. The counteraction, of money moving out of equities and into bonds didn't really show up in the longer yield. I think that was a question that I thought I would bring up because what are your thoughts on that aspect of activity in the market the last couple of weeks, where during the big run up that we've had post 2008, when there was a risk-off or de-risking going on in the market, like during the taper tantrum or 2016, there was a corresponding bump in the longer-term bonds. But in this period of de-risking, there wasn't as strong of a corresponding bump. Is that?
Yeah. So I'd say back in the taper tantrum and also during operational twist. It was a fundamental change in terms of what the expectations that the central banks were going to do. Also, economic data was very different then, where there's a fundamental change in terms of what the market's expectations for the economy was going to do as well.
Right.
So that's why we saw more of a shift on the long end of the curve. But in the last couple of months, where we've seen the equity market sell off. I think overall, it hasn't really been a fundamental change in terms of what the market anticipates the central banks are going to do. Economic growth expectations haven't really changed as well. But I think how the market is viewing it, if you're looking at long-term bond yields, is that this is more of a temporary setback in the equity markets. And when you're looking at fund flows overall in the industry, I think that's also supportive of the equity markets, or the market's view that the equity market is going to continue to rally as well. What we're seeing is we're actually seeing some investors actually allocate out of bonds and move into equities, which shows that they are still bullish about the equity market run-up.
Right. Yeah, there's certainly a lot to look forward to in the equity market in terms of the tax breaks filtering into the economy and into earnings, capital expenditure related increases in business as companies, and sort of there's also coming of the repatriation of offshore funds, right? As a result of the new tax rules.
That's right.
So there still remains a lot of bullishness on the equity side, but in the meantime, given the environment that we're in with inflation, maybe this is this equity activity that we're seeing in the market is not nothing more than a normal blow off or profit taking that should have come a long time ago.
Mm-hmm. Good pause, but hopefully not a long pause.
Exactly. Well, gentlemen, thank you very much. That was very enlightening. That was a great conversation. And want to thank you very much for sharing those thoughts and sort of demystifying some of the decision making ahead. I think the model portfolio offer that you've put together is certainly a good roadmap for advisors going forward in terms of how to use ETFs, what directions to take, and what segments of the market to look at in order to reduce and mitigate some of that interest rate risk. Thank you very much.
Thanks for your time.
And hand it back to Sveta.
Thank you. Thank you, Pierre, Alfred, and Kevin, for your insight on today's webinar. I'd like to thank you, the listeners, again for joining us. Remember, if you want to get a copy of today's webinar or you want to listen to a replay, you will receive an email within 24 hours to the conclusion of today's webinar that will have the replay link. I want to remind everyone to join us again the same time next week, Thursday at 2 p.m. for our final Canadian University webinar, the Graduate Seminar, Active ETFs, Why This is the Year and How to Blend Them with Your Passive Portfolio. I also want to remind everyone that if you like what you heard on today's webinar and want to learn more about fixed income ETFs or the current state of the Canadian ETF market or the latest investment trends and strategies on how to best use them in client portfolios, join us June 21st and 22nd in Montreal for our first Inside ETF Canada conference. You can register at insideetfcanada.com. Again, that's insideetfscanada.com. On behalf of everyone here at Inside ETF, thank you again for joining us. We appreciate your time and have a great day.